All right. I think we're live. I'm Matt Gougé, loan officer here at UMortgage. I've got the director of sales, Mr. Nash Paradise, and fun treat for anybody watching. We're going to talk about the real estate market. We're going to talk about mortgage rates and everything you want to know about that. And you're going to get insight from a couple of guys who aren't just talking heads on YouTube, but actually in the trenches, operating businesses day in and day out, talking to real estate agents, talking to consumers, talking to wholesale lenders on the mortgage side. So the loan wizard, Mr. Nash Paradise, joining me again. Thanks for being here, brother. How you doing?
Yeah, man. Thanks for having me. I'm good. It's a exciting Monday morning, coming back after last week with all the economic news, the week before with the election. It's fun to get back in here to maybe some normalcy and, talk about what things look like after all that.
Good deal. Let me know if my internet is lagging. I'm for whatever reason, laggy. Monday mornings, I think the computer wakes up slower on. All right. Well, what I might do, my friend, because I don't like to listen to stuff that's laggy, and I'm sure the audience doesn't like to listen to it either. So you rock. I am going to jump on my phone. We'll have, less for me to look at here, but at least we'll have a good feed. So why don't you start the good people off with your weekend, what you saw or heard, if you're out there having any real estate conversations, and I'll be back on momentarily.
Yeah, man. Since Matt's gone, he can't control what I say, so I'm gonna do what I want to do now. So how about that? I did want to let's backtrack a little bit, look at what happened last week and, what that meant, kind of what we talked about, summarize last week a little bit. So we had some big news coming out. Wednesday was the core month-over-month CPI, as well as the annual year-over-year CPI on the core side. So those both hit their projections spot on. 0.3% for the month-over-month, 3.3% for the year-over-year inflation figures, which is fine. That was expected. Expected is good. What really hit us last week was on Thursday was Powell's speech. That seemed to be the biggest market mover that we've had. And, the big takeaway from that was, hey, the data isn't looking as good as we would like. The impact isn't as significant as we had hoped. And, Powell expressed some reservation about doing additional rate cuts this year and basically made it look like the Fed was going to slow down. So, Matt, now that I got you back here, I completely ignored what you said and went off on my own and started kind of summarizing what happened last week after we last met on Monday with, where we were projecting things to go. And, thankfully everything hit right where we thought, our projections. But it was Powell's speech that caused some late in the week market movement. And you're muted, but you look pretty.
Well, you know what happened is as I'm getting ready to speak, I get a call. Now we're good. We've got we've got the phone muted. Nobody can interrupt this. What I love about this, Nash, honestly, is loan officers need to hear this stuff. Consumers are probably interested if they're looking at buying, but sensationalized headlines, rates are falling, some junk emails and texts that I get from different lenders that are just trying to stir up business. Like I love shooting straight with people. So let me ask you this question, right? Because you're listening to the Fed meeting, you're watching economic data. From what I've seen so far, and again, I'm a good test. I'm a public school kid, not the sharpest tool in the shed. So if I can understand it, most people can understand it. What I've seen post-election is that there's more certainty in the market, which is a good thing. There's also probably some tailwinds for the economy. If the economy is slated to do better, that's more inflationary. Do you see rates being higher for longer? That's the punchline, right? Is people are just like, a lot of words, Matt. What are rates going to do? And so I think, like what you said, Jerome Powell's like, hey, we're not going to probably be cutting as aggressive as we might have thought we were going to. That means higher for longer for mortgage interest rates to a certain extent, right?
I mean, I would almost rephrase that because, I'm going to put an optimistic spin on things. And, not only am I a public school kid, but I'm a college dropout, that 1.6 GPA in music school. I'm not certain we're the most qualified people to do this podcast anymore, but, 19 years in the mortgage industry, thankfully. I don't know much, but I know rates. Looking through this, I mean, I'd like to agree with you. I don't want to call it higher for longer. I want to call it slow and steady. The drops that we should see should be more incremental and it should be more data focused. The overall analysis and analytics of the just, high level economy, like you said, it's a fairly positive forecast, but I think you need to break down the differences in consumers and market movers. To consumers, we're still looking at high inflation. We're looking at numbers coming down slowly. It's not going to feel for the average individual like the economy is getting much better, much quicker. It's better quicker for the hedge funds, for the billion-dollar institutions, for the large cap stuff that, we see money moving out of treasuries and into stocks. And I don't know that that's necessarily a sign of strength as much as it is that consistency. Like you mentioned, we have a pretty good idea of where things are headed for the next 4 years. So people are going to want to make their money. And without any kind of quantitative easing, Fed purchasing of treasury bonds to keep those yields down, right now, there's just not a lot of good reason to expect high activity in the bond auctions. People want to be in stocks. And, that for the average consumer, that does mean higher for longer.
Yeah. Okay. Yeah. I want to pull up a slide and look at some interest rates, but after we talk a little bit about interest rates, I think it's important to talk about strategy. Like I've had more conversations over the last week with like smart buyers and smart investors that are honestly kind of excited that mortgage rates haven't gone down quicker because they're finding opportunities in the market where, sellers don't have 8 offers that they're going to, multiple counter offer 5 of them and they're going to get above list price. So it's a great time to buy, even though the uncomfortability, if that's a word, of higher rates.
Don't give away the ending, Matt. I mean, maybe it's a great time to buy if you're the right buyer. You got to tease them. You got to keep them holding on to the end of the presentation, man. That's what I'm here for. I got to keep you centered.
All right. Hopefully Caden's got the stuff coming up for us because, the rates, if we pull up that and we look at the last few months of rates, some people are going to misread this as like, holy moly, from mid-September, we've gone up quite a bit, hovering right around 7%. How's that affecting your client conversations or maybe even your conversation with the real estate agents?
It's one of those expectation becomes reality. It's all a matter of what are people thinking is there. When you came out of April, May into the summer months and people needed to buy and they're like, oh yeah, man, rates are at 7.5. And the market was telling you that. Yahoo was reporting that. You saw it all over the place. Yeah, well, buy a house with a 7.5 interest rate. And then all of a sudden we got rates at 7%. Later in the summer, people are like, oh, hey, it's coming down. My rate could start with a 6. All right, that's not too bad. Then you get into all the loan officers, realtors, rates are down, jump, let's go, come on. And we saw a massive surge in applications through about mid-September into early October. So now it's that expectation of, well, I thought rates were in the 5s. I thought I could get low 6s. And, the size of that jump and the speed of that jump post-election, I think it's just throwing a lot of people off. The market can balance just about any kind of interest rates. and you're going to have buyers and sellers. You're going to have things that make sense. But it's when we have a steep increase like this, you're going to see a lot of people pump the brakes because, frankly, they don't know, why did it go up so quickly? What can we expect? And, a buyer is going to be a pragmatic optimist and think, well, it just shot up really quick. Maybe it'll shoot down really quick. And, that's what we're here for, is to help provide some clarity around that. And, to be honest, there's no reason to indicate any kind of sharp decrease in rates. And there was a lot of good reason for the sharp increase. So, like we just talked about, we're seeing things drop slowly, but just providing that, insight as to why are we up near 7% and where do we expect things to go? People are still getting out there and realizing that, hey, that house that I really liked that was listed at 615, maybe I can get it for 585. Maybe affordability has pulled a lot of buyers out of the market to where, like you said, sellers aren't seeing a ton of offers. I mean, I'm selling my house right now. We've been listed since August, and, it took my neighbor 14 months to sell. So I knew that we were going to have a pretty long sales cycle for a unique property, but still we saw rates drop and I saw a lot more showings. We saw them go up, saw everything pause. That's got to be fairly consistent in most markets across the US. And I think that's where we get into strategy planning for buyers. Like, how do I make this make sense for me?
Yeah, no, 1,000%. I'm glad you mentioned kind of like the trajectory of rates really affects consumer behavior. Because like you said, this morning, I go to lock a 6.99 and somebody's been 6 weeks, 8 weeks from seeing any estimates maybe, or they haven't been as engaged. And they're like, oh my gosh, that seems high. In the summer, if you told somebody 6.99, they'd be ecstatic. And so I think that's another kind of thing to look out for if you're a buyer. If we go into the spring and now we're 7%, even if we're 6.75 and not even that much better rate wise, if we're headed down in rates and the latest 4 weeks, 8 weeks, 12 weeks is 7.1 to 6.9 to 6.85 to 6.78 or whatever those numbers end up being, the consumer is going to feel better about it because it's on its way down. And if the consumer feels better about the trajectory of rates, and you've got spring buying season where people are buying more than any other time of the year, I think that bodes for a competitive housing market, especially at the entry level, which I work with so many first-time home buyers in Sacramento. If you're buying something between, call it 400 and 700, there's limited amount of those homes for sale. And so if we get an increase in demand from better buyer sentiment, lower interest rates, time of year, the spring is going to be, competitive. And so I've been encouraged to see that some people actually listen, Nash. Some people, when it's put in a way where I'm saying, I promise you, I'm not trying to sell you. Fourth quarter is the slowest quarter for real estate, which means opportunity for buyers. Rates going up recently has pulled other buyers off of the fence. Like, if you're thinking about buying in the next few months, right now might be the time. What about that out there in the great state of Texas? What are you seeing as far as fourth quarter activity for buyers?
So a lot of the same, but I'm rephrasing it. If you can buy in the next few months, it's something we should strongly look at. And my frame up for this, my call to action to lenders, to real estate agents, even to buyers is, let's look at this, just objectively. Affordability. You're talking about homes 400 to 700. That's not my North Texas market for first-time home buyers. I got a lot of people trying to go in between, 220 and 350, where you can still get a nice house, but our property taxes are a whole lot higher. So someone who could afford a $275,000 house, it could still be a $2,400, $2,500 mortgage payment with a lower amount down. And, talking to those people, if they can do it right now, they can afford that $275,000 house. But what happens when the rates just even drop 1%? The number of people who can afford that is going to be completely different. You're going to see a lot more of those people. And so, on the alternative, looking in those higher price points, 500, 600, 700, where a lot of our neighborhoods are, there's not a ton of inventory, because if you're sitting there thinking about moving up to the next home, you're not going to sell your $600,000 house for a $900,000 house and have the same payment. And have your payment go up thousands of dollars. That's what we dealt with in 2020, 2021. You get out of a 6% or 5% into a 3%, you could go up a couple $100,000 and have the same monthly. Now that comparison, it's just kind of ugly. Like, it makes no sense to buy something that's just a small move up. So without move up buyers, there's not a lot of move out sellers. And without those sellers, there's not a lot of inventory. But with affordability issues, there's not a lot of buyers that can afford a $4,500 payment. So all that to say, when I have someone who can take advantage of the market, knowing that they have a lot of leverage over a home that's been listed for 30, 60, 90 days, let's figure out that math. What's the difference in a 7% and a 5.75? Look at it on a monthly basis. And then let's really dig into, where do we think we can get this home? At what price is this home so far under the market we've dealt with in the last couple of years that we can shoulder the extra amount on a monthly basis for the next, 18 months, 2-3 years, whatever? You can come out of this tens of thousands of dollars on the positive if that math works out, because you are someone who has the ability to buy now and you're not having to wait for affordability.
Right. Yeah. Which, oh, by the way, might never come. I hear that all the time, where it's like, rates need to come down this much, prices need to come down this much. And people are waiting for a magic moment in time where, if all the stars align and I can get my payment on this size house in this neighborhood, like for this monthly payment, sorry, I have to be the bearer of bad news. Like, it's not going to happen just because people want it to, right? Like, I want to buy in this neighborhood and I want a payment under $3,000 with 5% down. It might not come. And I'm not saying you must buy now, but like you said, Nash, those that are able to take advantage of the opportunity, operating with leverage is a good place to be as a buyer. So I think we got some slides about the future Fed funds rate. And I know you watch this stuff. You study this stuff, being the loan wizard, man. Tell us what we're looking at. December 18th Fed meeting. Guess that's about a month away.
So as of right now, and this data is from today, we're still looking at the majority of the Fed projecting a 0.25 point decrease in December. I'm going to go ahead and be the wild card here, and you can put me in that 38% mark. I am actually saying that I don't expect the economic data to support an additional rate drop then. A week and a half ago, I may have said differently, but we don't have a lot of news and data this week. We don't have a lot next week. So by the time we get into December, it's the next jobs report is going to be really, really telling. And honestly, I don't think it's going to look like enough has happened. I think they're going to have to keep rates where they are, which honestly could see a little bump up in mortgage pricing, because the dot plot shows a majority of the Fed is anticipating a 0.25 point. At some point, they're going to have to go back to Powell's speech from last week and do what they said, which is, we're not ready for this yet. The data does not match the need for additional rate cuts right now. Spending is still high, especially as we get into the holiday season. Spending should remain high. You get a lot of seasonal, temporary, part-time work that's going to be, injecting capital into the economy. I just don't see this December 18th drop happening, but that's based mostly on just my feelings, not necessarily. We don't have enough data to be more than feelings. And Powell's speech is the biggest mover for me on that.
Yeah, for sure. And, for a lot of people, I know that they're like, they don't want to hear any of the noise, economic data, blah, 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 blah. Just, I need mortgage interest rates to go lower. What I'm seeing from my lens is like I said earlier, higher for longer, which isn't a bad thing, right? But you're not going to see 5.5% by next summer if we continue on the trajectory we're on right now. What else we got? Let's take some future. That one's January, and what's that? Overwhelming one cut, like between the next two meetings.
Correct. So this is basically stating that as of right now, based on the current dot plot, by the 29th of January Fed meeting, the vast majority, comparatively here, are projecting that 4.25 to 4.5, which would represent a 0.25 point reduction. You can put me in that camp as well. I think it makes more sense that by the 29th of January, we see that 0.25 point. Now, could they do that December 18th and then keep it the same in January? They could. I feel like the Fed is going to be a little more cautious and skip the December drop and then make it in January. But there's so much data between now and then. And what we're seeing is the initial early projections that were more heavily weighted to that 0.5% reduction, that 400 to 425 range. That's evaporated into 18.6%. And I think as we get closer to December, meeting closer to January, we'll start to see these figures represent a little bit higher on those interest rates.
Cool. Yeah, I think we got one more. I want to look at that. Then I'm going to ask you a question and propose more work on your plate, which not really, right? I just think I got a fun idea. So this one is 1 or 2 cuts in 3 meetings, right? That's almost split, right? 39% of piece on those two.
It's not just, the 3 meetings. It's now we're talking about projecting all the way out into mid-March. So, without a February meeting, you've got the December, January, and now into March. And it's interesting. There's still a lot that's set to that 425, 450. So just anticipating a 1 cut between now and March 19th, I would say based on the previous data, they're really looking at either December or January. Again, I'm saying January as being that next Fed funds rate cut. But you've got almost as many folks saying that 400, 425. But at this point, we are so far out. Like we haven't really been within the Trump presidency. We have not seen some of the impacts that are all being projected, especially with regards to government jobs and tariffs. Those are the 2 big factors that are going to become economic indicators going forward. It's just too early to tell. Like anyone who's telling you they're confident they know which way this is going to go, they're lying. Like It's never been harder to make projections, especially coming off of a very divisive and complicated election. Like there's just a lot of unknowns right now, and it's definitely going to be a wait and see, which turns into higher for longer. And ultimately, the big money is going to be what moves things, and we're going to see whether or not we could have rate drops and rates not move. That's absolutely plausible that money just does not get back into the treasuries because everyone is now anticipating the stock movement. So even if we do start to see these Fed moves, that could actually make higher for longer work even more significantly. So as a mortgage professional, as someone looking into real estate and going forward, it would not be a bad idea that the Fed is pumping the brakes, keeping these slightly higher to try to shake some of the data more in our favor, because that will help squash the yield curve just a little bit, help margin compression right now that we're dealing with squeeze just a little bit. But I really am looking forward to that margin between the 10-year treasury and the 30-year fixed to come down a little bit. And I think if we can maintain the mid to upper 6s, we will find some first quarter balance in the market. But the late spring market is going to be really interesting to watch and see how that shakes out for everyone.
Yeah, for sure. And as somebody who watches this stuff, like I just have a question I think others have, like, can rates go higher? Could we go up over the next 3 to 6 months?
Oh, yeah. The market will maintain and withstand rates in about the mid 7s. Now, that was supported by a more aggressive summer season where you generally have a lot more buying and selling, and something that, it's hard to really factor in. You had a ton of new construction this summer. Not only a ton of new construction, you had a lot of new construction with builders who own their own lenders who are willing to do some very creative things, offering huge incentives, big rate buy downs, forward commitments where they buy bulk rates to be sold months before they're going to even start construction on some of these properties, allowing for that. Yeah, rates are at 7.5, but if you close with us, we'll get you a 5.99. And they're willing to take losses on the lending side in order to keep them, keep buyers coming in, keep their homes selling. It's all juiced up somewhere. You know how that works, but it did keep things moving fairly well. And it also had just enough, because people were still buying and moving at that time. There was just enough movement in the resale market to withstand and maintain the 7.5% rate. I think if we got there around this winter, I think we would see some pretty significant resistance to that ceiling. I don't think a 10-year treasury yield in the upper 4s as we get close to 5% is necessarily going to hold. I think when you start paying 5% money on a 10-year treasury, you're going to see a lot more, money come in to those treasuries, driving the price up and driving the yields down. So if I had to put a ceiling on something, honestly, I feel like the 10-year at about 4.5%, we've seen resistance multiple times. We're getting pretty close to that now. So we'll see if we get a resistance point if any more, negative economic news comes out.
For sure. All right, cool. Thanks for the slides, Caden. We can X-nay those. With the last few minutes here, One, I was going to say, this is a genius idea, at least in my head. Like,
Your
why
idea.
why doesn't Nash Paradise have a dot plot for mortgage interest rates? I think you might have answered the question for me already. Like, it's harder than ever to kind of predict what we're going to see in Q1, Q2, and the farther out, the harder it is to project. But wouldn't that be fun, dude? Like, have a dot plot that changes with time, and you're like, based on economic data, I'm going to change my forward guidance as Nash the Loan Wizard. But if you were to create a dot plot, and I pinned you down to Q1, Q2, Q3 estimates for like the average 30-year fixed mortgage rate in 2025, where would Nash Paradise put his dots?
So let me answer your first question, and I'll answer your second question. The reason I don't is because it can do nothing but cause harm. It's all it can do is hurt. Every single buyer is different. Every buyer needs a different plan and a strategy. There's a reason when someone calls you, they call me, that it's not just, yeah, now's a great time to buy, or now's not a good time to buy. We should wait for whatever. Everyone's going to have a special bespoke strategy just for them, their finances, their down payment, their needs, the type of neighborhood they want to get into. Every strategy has to look different right now because of the inconsistencies in the market. So if I was to do something like that and people were thinking, oh man, late spring, we should be like 0.5% better, I'm going to wait till then. That could be one of those buyers that I've never talked to, and that one of the people that really need to take action in January, February before they have to compete. So that's the main reason I don't. Plus, it is hard to project right now. One bit of news could change everything. And then if people aren't paying attention very quickly and seeing those updates, next thing you know, they had expectations that go unmet, and it could cost them tens of thousands of dollars in future equity because they're buying on, one of the lesser important things, which is the interest rate. Interest rates are temporary. That house is forever. So that's why I don't. But since you're going to force me to, and since we're on a YouTube podcast here about mortgage rates, I will go ahead and acquiesce to your request. Slow and steady is kind of the theme. And I know that's a cop-out, but, I am thinking that, we're going to be somewhere in the 7.1 range here through December. If we don't have a drop in December, I think we could even top out closer to like 7.19, 7.2. And then as we get into the early spring, that's where in first quarter of next year, I'm going to put my target estimate at about 6.88. So just enough under 7% that there is some feel good out there. You're going to see FHA VA rates in the low sixes when we get the conventional average in the upper sixes. And then by the time we get to the later part of the spring, early summer, let's call it mid Q2, after the March meeting and everything, I'm only projecting around a 6.7, 6.72. I really think that slow and steady is going to make the most sense based on what we're anticipating from the Fed, from our administration, everything going forward.
Cool. Yeah. I just wanted to reiterate, because you said it well, and I don't know if people caught it. Every single unique individual has a unique scenario, has a unique, kind of financial plan and profile. And so it would be like 500 people signing up for health insurance and everyone gets mailed the same, supplements. That's not how it works, right? Every single person is different. One, it might behoove them to wait for a number of reasons. Others, like you said, hey, you've got an opportunity, you're able to buy, you're looking to buy, and here's why it might make sense for you to do something in the next 6 to 8 weeks. So that's good. I tell that to people all the time, right? And we're trying to extract information out of people, not because we want to fill every corner of the application, but more we want to know people's goals, people's budgets, people's individual scenario, so we can advise them accordingly. So we're running up on 9 my time. I got to jump, but thanks, Nash, for all the insight, brother. We'll be back next week talking more of the same good stuff on Thanksgiving week.
Sounds great, man. Thanks for having me. Can't wait.
Yep. Have a good day, brother.
Take care.